This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Charles Biderman joining us today from Sausalito, California. Charles is founder and chief executive officer of TrimTabs Investment Research, an independent investment research firm. Welcome, Charles.
Well, thanks for having me.
I'm just marveling at the backdrop. What a beautiful day. That is not comparable to what I have here in Boston.
Well, somebody's got to live here in Sausalito, and not everybody can be in Boston.
Yeah, exactly. But I have the Patriots, and so maybe that'll count for something here and there.
Well, we got the Warriors, so.
Okay, Charles, let's begin. So we have lots of time. Could you give our listeners a bit of a background, outline of the kinds of things you're involved with?
Sure. Well, we started TrimTabs Financial Services, or it's currently TrimTabs Investment Research, in 1990, concentrating on real-time data and what's going on in the stock market and the economy, as opposed to historic data or past data or surveys or whatever, or earnings. So we say that all there is in the stock market right now are shares of stock and money. And in every market, the house has an advantage. And so the house and the stock market are the public companies. It's their shares we play with. They know a lot more than the players. And so we say, if you want to beat the market, follow the house. And which is what we've been doing since we started.
And how's that turned out?
Well, it turned out quite well. Back in the twos, Goldman Sachs was a minority shareholder of ours, and all the prop trading desks on Wall Street were clients. They saw that there was significant alpha in following supply and demand of shares of stock and money, and take free cash flow and float shrink, and we have created a demand index of 18 flow variables. Each one is alpha creating. And we were doing fine until 2010 when the Volcker rule was announced, and Paul Volcker said companies like Goldman Sachs shouldn't be able to trade for their own account. So we lost half our revenues that day. Fun day here. We decided then that instead of, if we can't make the decent living we were making selling research to the prop trading desks, maybe we could create some retail products with our data. So in 2011, we launched TrimTabs Float Shrink ETF, which invests in the 100 companies that are reducing share count the most, only using free cash flow, and only if the debt equity ratio is not rising. So therefore, a company like IBM, which today reported horrible earnings, lower sales, lower numbers, they've been reducing share count regularly. They've been borrowing to buy. And at some point, it's going to hurt their survival capability if anything bad happens, increasing leverage to shrink the float, even though their cash flow is declining.
I think today it's finally starting to come to roost. And
I haven't seen what it's done after hours, but it can't be pretty.
Charles, we're here to talk about financial repression, and all it comes full circle all the way around, because it does tie into buybacks and the kind of manipulations that are going on in the market. And you were the first one actually to bring this in primetime TV, that the Fed was buying shares in the market. So, but before we get into that, could you define financial repression for our listeners, what it is to you, what it means to you?
Well, I think, to me, the market's rigged by zero interest rate policy of the central banks. So to the extent that the markets are rigged, it's not a free market. So that would be financial repression.
And what does that mean to you, though, as an investor?
Well,
Can you take advantage of it?
Well,
what do you do about it?
Yeah, we've been well. So here's what let me give you as I see the world and how this all exists within it. Give me a few minutes.
Sure.
It's we're in a no growth world. We have governments in the United States, in Europe, in Japan, in China that are anti-growth, anti-free market growth. On the other hand, we have central banks that are committed to creating as much money as necessary to keep stock markets as high as they can be. Even so, we have a total disconnect between the economy and the markets. And the only reason the markets are doing as well as they're doing, both equity and bonds, is because of zero interest rate policy of, in essence, free money from the central banks. So when I was on with Rick Santoli on CNBC a month or so ago, I said that the zero interest rate policy of the global central banks is creating a global recession, not a global recovery. Remember, this whole free money binge was supposed to be a bridge over the downturn that the economy would then recover. But when you have no growth and anti-growth policies in place prohibiting real economic growth, you're going to have no growth and higher prices. So they can't end, it's like, are they really going to increase interest rates and end the zero interest rate policy? Well, if they did, we'd see a tremendous economic slowdown, contraction immediately. So even if they did, it wouldn't last very long. There's no fundamental economic growth in place. Let me give you some examples of why I say that. Despite, you can look at job growth. Okay, since Obama took office, there's about 2 million or so more jobs now than before he took office. However, there are less full-time jobs now than when he took. So all the jobs created are part-time jobs. Whoopee. Also, of the 2 million or so new jobs, the population growth has been like 16 million, and we have 2 million new jobs, or 1 in 8 or 12.5% of the population increase in the United States got new jobs. Under George Bush, it wasn't much better. It was 25% of the population increase got new jobs. But under Clinton and before, it was 75% of the population increase got new jobs. So we have a situation where there's no job creation because it's anti-growth. And so why is it? The other reason, and the scariest data set that I've seen, the data is only through 2012. It shows that new business formation is now less than businesses shutting down. So up until George W. and Obama, we had many more businesses being created than shutting down. In this era of high regulation and all what you got to do, and you got to hire this, and you got to have these benefits and minimum wage, and people aren't starting businesses. The Wall Street Journal had an article 2 weekends ago now that said millennials are not as big risk takers as older generations because they're starting less new businesses. Well, I don't think that's the case. I think millennials are just as entrepreneurial as any of us, but it's so much harder to start a new business that less of them are getting started. Yes, here in the Bay Area, if you want to have a new app or some social media thing, yeah, you can get money, you can start that. But outside of that, what, restaurants? What's being started?
A report that was just out from the Gallup Group was showing that 70,000, the net increase in new businesses, those that are failing and stopping and those that are starting, is a net loss of 70,000 businesses in the last 6 years.
That's my point.
It's just it's dramatic.
It's unprecedented in the United States.
Absolutely the right point.
So Warren Buffett says, don't bet against the United States. But we've created so much headwind that, you know, now Obama wants to increase taxes so he can give everybody a free education. You know, the biggest growth area are college administrators. Second, I mean, the real biggest growth area is healthcare, because all these new regulations saying that anybody should be able to get free healthcare in essence, and the heck with the costs. We'll just print money and pay for the cost of it. So what, as this money that the government's borrowing will never get repaid? People now deserve to get free healthcare. Forget the cost.
Well, we're about to announce free education for community colleges.
Well, that's what I was just saying. You know, we need to raise taxes on. That's never going to happen, I hope.
The growth is slowing. Is not just the U.S. As you said, it's globally. We have a slowing growth. As a matter of fact,
we have no growth.
Exactly. I've been arguing it's been negative for numbers of years. If you use a proper deflator, which is an orchestrated number from IMF, etc. If you believe inflation is 1.8, you could accept their deflator. But inflation outside the United States is dramatically worse in the emerging markets in China, etc., than it is in the United States. So it makes no sense, because that's where the dominant growth GDP number comes up. So we are actually contracting, Charles, in my assessment. Not just slow growth, contraction.
Well, the borrowing of, when you create money, you in essence create debt, because the government, you know, creates debt and it gives money away. And if that money goes to front-run demand, in other words, if it's easy to borrow money and get money for capital, if there's no cost, why not create millions of barrels of oil, extra oil? Oil can only go up in price and demand can only go up, and there can't be such a thing as too much supply of oil, except we did create that. All the incentive to invest, and oil was the most productive investment, billions and billions of dollars has been invested in creating new oil production. But when you get excess supply and you have the Saudis saying, hey, wait a second, we're not interested in cutting supply. We want to bankrupt the Russians and the Persians, the Iranians, and the Bakken. And we want those guys to go down the toilet so that when they're flushed out, we can sell our oil at a much higher price and we don't have the competition. So what, you know, it's like all that happened. And so then also add in China deciding that it wanted to build gazillions of billions and trillions of dollars worth of cities, you know, Chinese renminbi currency equivalent, that are vacant, offices, shopping centers, houses, all vacant. All that debt is owned by Chinese banks, and all the materials to build that, a lot of that came from the outside of China. And so commodity prices were super inflated by that spurious demand. And now that China is, in essence, bankrupt, all the banks have debts that they can't really collect because there's no value to those properties they built. Nobody's in them. They have no use, no income, and lots of debt is not a good sign for a bank, for their assets and the loans that those banks lent money to build.
People don't fully realize that the Chinese miracle, when you look at GDP, is based on 40 to 45% of that number is investment, the I in the GDP calculation. And that's a big problem. And it's a wonderful problem if that money's being invested in productive means.
No.
But clearly ghost cities beg the question, don't they?
Yeah, so we have a commodity deflation. Why? Because all zero interest rates brought forward demand that would, you know, instead of each year, it's like pushed it forward. And now we're, you know, car sales are going to plunge at some point soon. You know, anybody who's breathing can get a car loan.
Well, they don't call it
default rates are surging.
They don't call it subprime anymore, Charles. They call it deep subprime for car loans. Because you can remember when subprime was a problem.
Yeah, and that's obviously going to have to be a problem. And,
exactly.
And there's no way the hundreds of billions of student loans can get repaid. I mean, it's, you know, give the students money so they can pay inflated expense of college where they don't learn anything useful.
Well,
But at least we have...
Charles, what we're doing there now is we used to measure delinquencies and defaults and the rates, et cetera, and we're all very familiar. Now they have something called forbearance,
Yeah.
which is dramatically changing the outstanding student loans in there. Then you get into, well, what is forbearance? And you start to see these very new, interesting government programs that don't seem to be in the public press. But
It's called defer the pain.
And big time, big time.
Well, you know, it's like people shouldn't feel pain. Everybody should be happy. Don't worry, be happy. The government will take care of all our worries, except until people recognize that the government is really naked and that it'll never meet the claims against it. Government can't. You know, here's a piece of data that I'll bet none of your readers or viewers know. I'll bet, you know, you might, but I'll bet most don't. So no one, it took me several years, 4 or 5 years of looking to discover what the present value of unfunded future liabilities of the U.S. government is. You would think that should be a number that's readily available.
I believe it's $45 trillion. Kotnikoff in Boston believes it's $210 billion.
Well, actually, if you
trillion, I meant. I apologize. I meant trillion.
Well, if you go to the trustees report of Medicare, the trustee of the Medicare, and I can give you the page and where to look, they actually have the present value of future government liabilities for Medicare, Social Security, OASDI, government pensions, and it turns out to be the present $80 trillion. Add 16 trillion of government debt to that, you get 96 trillion. And then if you go to the Federal Reserve's Z1 flow of fund accounts, which has a balance sheet for the United States, value of all stocks, houses, assets, minus all debts, that's 80 trillion. So debt, if you added the net present value of future liabilities to current debt of 16, the United States is bankrupt. Now, if the United States were a public company and a public company hid in the footnotes its net present value of future liabilities, people who run that company would be in jail.
25 to 30 years of hard labor.
And yet the government is so audacious that it thinks that it doesn't have to tell taxpayers and government debt holders that the real net worth of the United States is negative. So there's no way, even if the United States economy would need to grow at close to 10% a year to be able to fund that deficit in the future. There is no way that we're going to grow anywhere near that. There's no way we're going to meet those and nobody talks about it. I brought up this data to some Republican senator. I won't say from where, who his name is, but he's from the state of Illinois. And he said, oh, this is interesting. Oh, wow. Let me take a look at that. Did I ever hear from him? No. So it's not just the Democrats. It's the Republicans. It's all of them in Washington. The real problem, as I see it, in our current way of doing government, is that over half the time elected representatives spend over half of their time raising money to be reelected. If they spend over half their time raising money to be reelected, the people who give them the money run the show. And who runs the show? Well, just look at where the government spends its money. Government employees, healthcare, all those areas have deep vested interests. They pay for the re-election of the elected representatives. $8 billion was spent on the last election. $8 billion? And where did that money come from? It came from the people who are getting government money. So they are not going to allow any change to the system. We are headed down a road where the special interests will not allow changing in spending, no changes in taxes, So at some point, people will realize the emperor is naked, the United States debt is not worth the paper it's printed on, and we need to alter the way we do business as a country.
How is this going to end? because the chances of altering this are slim to none without a crisis. But that's
well, it will be a crisis. We will have to mark down government debt significantly. We will have to, look at Vallejo had all these great government programs and pensions and retire, and they went bankrupt. And now Vallejo works very well. It lives within its budget. It provides services, nowhere near to the extent that it had. It just had to restructure.
Charles,
why can't we do that? And we will. We'll be forced to.
Charles, what does an investor do today to protect themselves from this what's going on and what's in the future?
Well,
what are you doing about it?
When I talk to investors, I say, one, there's no relationship between the economy and what's to come and the stock market. Zero interest rates, free money has altered the investment. There's no relationship between the underlying economy. So again, to repeat, the underlying economy is contracting, as you and I both agree. Mm-hmm. And in the U.S., the only growth is really due to government manipulation of things. Without that, there's no growth. Housing market's not growing. Automobiles have been boosted, but that has to slow. What else is growing? I mean, yes, Silicon Valley, we're creating good stuff here, and that's boosting. But other than that, what's growing? Restaurants? McDonald's? I don't know.
Waiters and bartenders, the biggest growth.
Waiters and bartenders are doing well. College administrators are doing well. And people who run hospitals and insurance companies and drug companies, they're all making gazillions of dollars because the government, everybody should get free health care and forget about paying for it. So how do you invest? So that's the economy. The stock market, though, as long as right now, since 2011, the number of shares in the U.S. stock market has been declining over the last 4 years. So consider that 80% of the shareholders and shareholdings in the United States stock market are held by institutions. And institutions typically have a constant cash percentage. An ETF at 0%. A mutual fund that might be 2%, whatever. There's a constant cash percentage usually. So if the number of shares held by the 80%, by those who hold 80% of the market, the number of shares goes down, these people have more cash to invest in fewer shares. So more money chasing fewer shares. What's going to happen? Well, a triple in the stock market since 2009 is what's going to happen. And so over the last 4 months, the share count's down 1.1%. So unless what's going on now leads to major bankruptcies of banks or global instability, which is possible, and there's a certain percentage likelihood of that, which is sort of priced into the market. But if that doesn't occur, I expect a major rebound in the next few months. But again, at some point in the future, the world will recognize that the emperors or the central banks really have no clue. They have no idea what they're doing other than giving money away. It's been helpful. You got to remember, 65 out of 67 economists this year, last year, and the year before, roughly that same 95% plus, have said that interest rates have to go higher because the economy is going to grow sustainably. So interest rates have kept going down. The economy, global economy, is not growing sustainably. And the economists still say that interest rates are going to go higher and the economy is going to grow sustainably. Now, the point of emphasis is that if I'm correct, and I think I'm correct, almost all senior officials at the world central banks are economists. So if 95% of the economists who outside the central banks are wrong, what makes us think that these economists who run central banks have any bigger idea of what's going on than their moronic friends?
I just did an interview with Martin Armstrong, who's been consulting to U.S. government treasuries and other treasuries around the world, and he defines it as the Keystone Cops. He says, whatever you think, do not believe they know what they're doing. They haven't got a clue. He said to me, Gord, he says, I almost wished it was a conspiracy because there would be some level of intelligence. It's just incompetence.
Yeah. Well,
I think it summarized it quite well.
Look, the bottom line, parasites are committed to the death of the host by their action, but they will defend until the host dies their action, saying they actually are helping the host. So we have a government that is killing the economy and telling itself and its friends who are benefiting from this action that killing the host is good for the host. And they'll keep doing it until the host dies, and then the game over and we start again.
Charles, what does an investor do tomorrow morning?
Well, I have a vested interest. I have some products that we created to take advantage of this. So obviously I'm going to tell an investor to invest in our products. One of our products is TrimTab's Flow Shrink ETF, which is an ETF that invests in the 100 companies shrinking the share count the most in the US. We soon will be launching a global free cash flow product that will invest in the 170 non-US companies growing free cash flow the most in the 10 largest non-US markets. And the third is something called Turk Capital, which we're partners in with Peter Turk, who was a client of ours, who took our demand index, which follows money flows, and now has a commodity trading, it's in essence a hedge fund that invests only in S&P futures based upon our demand index. So as in 07, 08, when demand was negative, the fund would be short. Right now it's a little over neutral, so the fund is long. It could go double long and it can go double short. So when liquidity turns bad, we expect that this fund will be bearish. And so I'd say I have 1/3 of my money in the fund, which when the market cracks will turn bearish. And then 1/3 in US and 1/3 global. And because who knows when it's going to turn bad. It could be next month, it could be next year, it could be 5 years, could be 10 years. I haven't been to the future and come back to report. As long as the share count keeps declining, I want to be bullish. When it stops, I won't be.
And this is what you're doing with your personal money?
Yes.
Yes. For the sake of full disclosure, I wanted to make sure that our listeners understood that.
It's not all of my personal money. I obviously have some gambling, trading money, but the bulk of my portfolio is situated, like I said.
Charles, we have to wrap. Any concise message for our listeners that you'd like to leave with them?
Good luck, good investing, and ignore government data.
I have heard many times from other people we've interviewed, is don't trust the government's numbers, don't trust economists, and don't trust what you're being told in the press. Do your own homework, do your own reading, do your own investigation. I guess yes. It's always been very true. Could you tell our listeners how they could learn more about your writings and your investments?
Sure. Well, charlesbiderman.com is the name of my personal blog site where I put each of my TV appearances and some jottings, and up until a year ago, I used to do several videos a week and post those videos. But now I just keep I'm on typically once a month with Rick Santoli and Joe Kernan on CNBC, and so those are on there, and this will be on there. And then there's a link from there to TrimTab's investment research and TrimTab's asset management. If you want to find out about our research products or our funds, you can go from my blog site to the rest of the company and see what else we have to offer.
Charles, keep doing great work. The time you spend with Rick Santoli is absolutely the best CNBC does. There's very few shows that I actually tune in to listen to. You were the first to call that the insider, the buying that was going on by the Fed, the amount of buybacks that were going on. The emperor has no clothes. Very few people talking about that. You brought it up in primetime TV.
Thank you.
So all the best, and let's hope everybody makes a lot of money in 2015.
Yeah.
Well,
at least our people who watch us.
You bet, absolutely. We'll have you back later in 2015.
Thank you.
Talk to you. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.